Okay. All right, here we go. Now, a little bit of a technical glitch there, folks. Is everyone on? Give me a shout out in the chat if I can see you. There you go, Jace. Had some technical difficulties this morning. Sorry, folks. Great that you could be a little bit patient and hang around with me while I got that sorted. But awesome to see you guys here. Oh, yep, there we go. We're off and away. We're off and away. Well, Monday, there you go. Usually I'm pretty fresh for a Monday, but you know, over the weekend did some cool things with a community of mine. I'm a bit of a climber, a bit of an outdoorsman, and went and supported over the weekend a bouldering and climbing competition, which was kind of cool. We live streamed it, and I did some commentary. It was a bit of fun. And it was all for the young and up-and-coming rock climbers in the Gold Coast in Queensland. So there you go. I hope you're all well wherever you are. Just make sure. Yeah. All right. We do have a couple of little tweaks going on. Sorry, folks. Anyway, I think I've got it sorted now. Anyway, well, let's see if this works. This one works. And so today, team, I wanted to talk to you about the idea, something I see. Yeah, listen. Anyway, there you go. A little bit tired from the weekend. But one thing I want to talk to you guys about, which I see all the time, that advisors, especially accountants, get wrong, property investors get wrong, is the idea that I turned off my mic in one of my scenes. The mic is off. The mic is off in all of my scenes on my little computer here. Sorry, it was turned off once, and then it's obviously gone and turned it off in every single scene. So I'm just going to flick through. Hopefully the audio is still there. Yep, we're still there. Audio is good. Audio is still good. Audio on. That's my name again. And back to the main camera. Anyway, there you go. Well, thanks for being patient again on that. We got this sorted. Really sorry. Anyway, all right. Maybe I should have had a couple more coffees before we got this going this morning. But there we go. Let's kick into gear. Let's do this. Depreciation and negative gearing. One of the things I see property investors and accountants and their advisors really sadly misunderstanding how to use it and when to use it, and is it good, is it bad? There's this kind of rhetoric that goes around that negative gearing is bad. No, rubbish. Negative gearing is fantastic. There's nothing wrong with negative gearing, all right? Negative gearing, team, is the process, the financial process of you as an investor. A property investor especially has some significant advantages when it comes to real estate because it's depreciation, and we'll talk about that in a minute. Negative gearing is the ability for you as a property investor to offset your tax that you would pay with some of the losses that you have incurred while investing. Now, this is where everyone gets this wrong. This is where everyone confuses themselves and/or their accountants or very ill-informed, well-meaning people. Negative gearing is bad. Negative gearing is perfectly fine. There's nothing wrong with it as long as you understand how to use it and what it's for as we go. Negative gearing, let's talk this through. Number one, there is a difference between, I'm going to use just the symbols, make this easier this morning, okay, as we roll along. There's a difference between negative cash flow and negative gearing, okay? Negative cash flow is bad, okay? Don't do it. Negative cash flow is bad, which means you buy an asset, a property, and you have to put your hand in your own pocket to cover and pay the cost of the property. You know, the rent comes in, you get $20,000 a year for the rent. The interest costs are $25,000. There's another $5,000 of cost, and you're $1,000 a month or close enough putting your hand in your pocket and paying out. That is bad, okay? Big no-no, team. So you don't do that one. Now, a lot of people get confused with negative gearing and negative cash flow, all right? Now, can you offset those losses? You lost physically paper, cash, dollars. Can you offset those dollars as a loss, and you can offset it against your tax? Yes, you can. But a real cash loss is hard to swallow. And I know many of the investors that we work with, many of the folks out there, you can't afford that. You can't afford $10,000. Even after tax, if you offset that $10,000 cash loss, you get maybe $5,000 back. You're still negative $5,000 cash in your pocket. It doesn't work, okay? So negative gearing is perfectly fine. Nothing wrong with negative gearing. Negative gearing is the process of applying a loss to your income to then offset, excuse French, offset the amount of tax you pay. All right. Now, I'm probably not telling many of you guys something that you don't already know, which is great. It's great to see many of the clients in the mentoring program making sure that they claim their taxes. But here's some of the challenges I see with some of the advisors and some of the team out there when it comes to the people they listen to or the people they're getting advice from when it comes to depreciation and negative gearing. What goes up in value, team? Chuck it in the chat. There's two parts to real estate. There's two pieces to the real estate game. There's the house. There's the piece of, there's all the materials. And then there's the land. Which bit goes up in value? All right, tell me in the chat right now which bit goes up in value and which bit technically goes down in value, okay? We get some capital growth, yes. The capital growth and the rent goes up in value. But specifically, James and Sam, Sam's on it right now. Sam, the land value. So the land value. Now, I'll put a little caveat in there, folks. Even with apartments, townhouses, and houses, it still plays true. Land value, you know, even though the pieces of land in comparison for an apartment is quite a lot smaller, land or location value increases, okay? So the land goes up in value. Let's look at this as we're having a bit of a look. Oh, there's my little thing, my giveaway here. So the land goes up in value. So we've got a block of dirt. That goes up in value. Okay. But the house goes down in value, right? Okay, it goes down in value. Let's say the combination that you paid was $300K for the land and $300K for the house, okay? So let's say that the land value or the combination of the two technically went up to 400K, and now technically the house value went down to 200K, let's say over a 5-year period, okay? 5 years. So this is the process of depreciation. This is depreciation on your house, on your property, and this is how we get the ability in real estate to get some fantastic tax deductions, team, okay? Tax deductions in real estate. Now, I've heard this, unfortunately, many times from, let's say, well-meaning accountants, and maybe not even well-meaning accountants. Sometimes they're just bloody lazy. Oh, don't claim the depreciation. You only have to pay it back when you sell it, which is true. There's a certain amount of the depreciation you have to put back in, and then it all gets divvied up and calculated for a capital gain, right? So what happens is you claim the taxes as you go, team. So that's the depreciation, and you offset against your income. And then if you were to sell that property, then you would have to add back a certain amount of that depreciation back into the price or the calculations, and it would be all then calculated in capital gains tax. Matter of fact, in the long run, capital gains tax is the most efficient tax to pay because you can manage it, and I'll talk about that another time. But tell me, gang, what's the secret? What's the secret here at Positive when we talk about buying? What is our catch cry? What's our number one catch cry here when we talk about this, which would be completely irrelevant to that conversation? Number one, don't claim it. You just have to pay it back later, which, who cares? Because we are here for what? We're here. Hey, good work, Pritesh. Buy well, never sell. You buy well, you never sell, then who cares? You get to keep the tax deductions forever because this property is yours to keep forever, okay? We're buying something that we're very happy to own and maintain into the future because that's the point, team. That's the point. Well, that's what we're doing this for, okay? So don't listen to that rubbish. And even if you chose or sold a property, then you divvy it up, you wash it all out, and it's not like there's there's money you have to pay back in real cash. It gets divvied up in the capital gain, and away you go. So not a big deal. Now look, folks, if you're a high income earner, if you're earning a combination between you and your partner over $80,000, then this stuff like positive, negative gearing to create a positive cash flow property or accelerate your cash flow is absolutely fantastic. And for those earning a little bit less, it's absolutely essential that you get this extra boost, this extra bumper for your property and your cash flow. Okay, so your house value went up, or not? Your land value went up. Your house value technically went down. Okay, and that's not exactly true, by the way, folks, because inflation and all of this sort of stuff. Okay, because technically the underlying value of a house to construct the house goes up over time too. So technically that's not super accurate, but for this demonstration, for depreciation, who cares? Basically, the ATO says that a bunch of this stuff in the house has gone down in value. You can offset that against the income that you earned this year and pay less tax. Boom. And let's have a quick look at what that looks like. Hopefully my screen here works, my little screen share. Hopefully you guys can see that in there when we're looking at this. Make that a smidgen bigger. So if you guys can see the calculator there, if you go and buy a property, let's say $600,000 up here, chuck all the numbers in there, and I've just pre-done the numbers. Interest only, team, remember that? Interest only for the first 3 to 5 years. Build that buffer up, tuck that money away, and we come over here. I've just put an average annual income of $100,000. That's not the tax rate, by the way. That's the tax paid in cash, team, as we go. And then, chosen this calculator here. You can go off to BMT. There's a little click on that button there. You can go off to BMT QS. Those guys do... That's the way to roll, Alison. The house keeps going up. Quality problem indeed. You get some depreciation on a property, all right? And what that does is it flows through, team. It flows through to here. And I'm not going to dive deep into the calculator. I've done that before. But what happens is your rent comes in, your total interest plus your property expenses. It's actually just the property's a smidgen positive cash flow. So it's cash flow right off the bat in your pocket, all expenses paid. But on paper, because you have this depreciation of $25,000 plus all of the costs, which is the interest and the property expenses, etc., they all add up to the total deductions. Technically, on paper, you made a $26,000 loss. So of the $25,000 over here, look at this, of the $26,000 in tax that you paid up the top there, all right, then you get $7,000 of that back. Boom, mic drop. Okay, fantastic. And here's the other stupid thing I hear. Here's the other stupid thing I hear from advisors and stuff like that. Listen, I wouldn't rely on it. It's not real money. What a stupid comment. It's real money. It's cash. If you don't want your tax deductions, if you don't want your depreciation, give it to me. I'll happily take it. Let me tell you. At the end of the day, folks, every cent counts when it comes to us keeping going when it comes to our property investing, okay? The other thing that I hear often is accountants say, oh, you should buy this in a property, this property in a company trust. And for some people, that is appropriate. But for most PAYG, it is completely inappropriate, okay? Because the accountant's going, oh, later on, when you sell it, we're not selling it, folks, just so we know, we're not selling it. Or later on, you can do this stuff with capital gains tax. Well, who cares? Because if for the next 30 years, that property is negative cash flow because I can't claim any depreciation and I can't directly in my personal income as a PAYG earner get any of my income into a company or a trust, then that's a stupid idea, okay? And I might do a bit of a wealth copy chat on that one too, folks, if you're keen on that. And I know one of the team asked me the other day to dive into what's repairs and maintenance and what's capital works, and I'll jump in on that one too. Yeah, Alison, that's it. Setting up a company or a trust is expensive, team. Expensive. And it traps all the losses. It traps all the depreciation inside the company and trust. You can't use it as an individual. So not only you can't get any tax deductions as an individual, you pay more in interest. Often it's harder to borrow. And then it costs you between $2,000 and $5,000 to do the tax returns every year. It's a disaster. It's a nightmare to own properties in company trust for 90% of property investors. It is inappropriate and it drives me nuts, just like Alison's saying. So be aware, folks, that who's talking to you about what, because sometimes they're not necessarily thinking about you. Now, here's just a quick example. Alison will be pretty happy with this. Here's a quick example of when we talk about the flight to quality. I might make that a little bit bigger. Let's do that. Yeah, that's a bit better. When we talk about the flight to quality, team, when when we talk about the quality of the properties that you get to invest in, sometimes people say, apartments. Now, listen, gang, I love apartments, houses, townhouses. I own all of them, okay? I have no bias or from one to the other. I've never experienced something better or worse when it comes to either of them. The challenge is, for me, and maybe for you, apartments are easier to get wrong than houses. That's what I see often, because most investors go for price over quality, and that's a poor choice. That's a bad way to invest. But anyway, that's not what I'm talking about today. Let's just look at this. Depreciation with a furniture package in a couple of these opportunities, $31,000 of depreciation in the first year. Check that out. If you're on 100K, now you minus $31,000, okay? That is now your tax rate, team. Your tax rate now has dropped. Your income, because that 31K, and there's probably more expenses there, to be honest, because you've got interest and all that sort of stuff. Let's say the interest was 20K as well. All right, so that drops it down to $49,000 of income, right? You've got to add back in your rent, et cetera, and all that sort of stuff. But you get it, team. Like what that does is it drops your depreciation down, or your income down, and you get to pay less tax. So this is flight to quality. This is quality, okay? Flight to quality, quality properties, quality properties, plus often a good furniture package can get significant tax deductions, which is just amazing for property investors. So there you go. Ben, give us a shout out here with a quick question. He said, okay, what about business owners? Ben, depending on the business owner's setup, sometimes it's appropriate for a business owner to have company and trust structures. So you and I will catch up on that one. What I do like, though, for me, is the first maybe 3 to 5 properties, even if you are a business owner, can be purchased in your personal name, because that is there is an extra tax minimization strategy there with personal name and being paid and PAYG income. There's quite a lot of benefits in setting yourself up looking like that. And then anything over and above those properties, then certainly company and trust structures certainly help. So let's catch up on that one, Ben. I know you and I have got a few chats to have. And Alison, yep, get your money back out and move on to the next deal. The faster you do that, team, the better off you're going to be, okay? Buy well, never sell. This thing's a marathon, not a sprint, and every cent counts. And last but not least, one of the big misnomers I hear from, accountants and that sort of stuff. Oh, wait till the end of the year to claim your tax. No! Claim it as you go. You are paying your taxes as you go. You can do what's called a PAYG variation. And every week, fortnight or month, depending on your pay cycle, you can get your tax minimization going in that sequence. So, folks, there you go. Hopefully that made sense this morning. Sorry about the technical difficulties we had. We started a little bit late. I know everyone's got to go, 8:30. Everyone's got stuff to do. So I'll leave you guys to it. Another Wealth Coffee Chat done and dusted for 13th of September. Tomorrow, we'll go off without a hitch. No technical difficulties tomorrow, let me tell you. We'll see. We'll see how we go, Jason. All right. Great to have you guys here. Thanks for joining me, folks. And, let's hang out tomorrow around about the same time, 8:05, for another Wealth Coffee Chat. Bye, team. Take care. Bye.